Goodness, great to see so many people coming on quickly. We've got, what is that, 48 there, and I think there was just over 100. So I'll wait another minute or so to let everyone get in, and then we'll crack off. All right, we're at 65. I think that's probably enough to go because it's still a fair number of people on the call. Kia ora and good afternoon, everyone. Thanks so much for coming along. My name is Brad Olsen and I'm a senior economist at Infometrics, and we're going to today just wanting to discuss some of our thinking around how the COVID-19 pandemic and response is currently affecting both the national but also the Kapiti Coast economy, and going through some of those bits and pieces. You'll note down the bottom of your Zoom screens, hopefully, there's a couple options there. One of them is a Q&A option. Feel free to put your questions in there and type them out, and I will probably not answer them during the first part of the session, but I will get to them in the second part. So we've got roughly an hour. For the first half an hour or so, I will go through sort of our thinking in terms of how we see the global and national economy changing, and then looking a little bit more specifically at the Kapiti Coast and how we are envisaging some of the sectors in that area might change. What we'll then do is sort of go over to that question and answer bit in the second half hour or so. I'll be sharing my screen throughout as well, and don't worry, we will have a copy of this webinar provided to Kapiti Coast District Council, who will able to be share that out further to the different networks. So I guess, and just noting with all of this, you know, these are very strange and uncertain times, and some of the things I'll show you today are probably not going to be particularly optimistic. I suspect, in fact, our view is one of the most pessimistic for how the economy is likely to evolve nationally, but at the same time, we do feel that is the most realistic outcome given how much of a structural change COVID-19 presents to the economy. So let's dive right into it. And I'll share my screen with you firstly and show you some of the important numbers here in terms of the global picture, and we'll sort of take that wider view and then zoom in a bit more. So 1.346 million cases of COVID-19 around the globe. Obviously, the epicenter now very much rests in the US. There's been an increased concentration of cases there, and they are having probably their worst week on record at present. Still do remain issues in Europe particularly. We've seen increased case numbers in Italy, Spain and the UK, for example, and obviously Boris Johnson, the Prime Minister of the UK, went into ICU earlier this morning. So some changes coming through there. And I guess just noting that we have seen the evolution of the pandemic from China firstly, and then out into Europe as the sort of second epicenter, if you will, and then on to North America, particularly the US, as the current and prominent epicenter, and this is very much reverberating throughout the world. One of the other things I want to show you, though, is if we focus a little bit more on the New Zealand story and thinking about, okay, how are we seeing this affect the economy? And once I go through that, we'll then sort of talk about how some of these higher national level trends are going to translate through to a more local level. And in terms of time frame, what we're expecting is that this very much could be, we're in this for the long haul. This graph here, which is publicly available, just notes how our economic growth expectations have evolved over recent times, and we have seen our growth forecast dip even lower than this at the moment. We're currently preparing new forecasts, but you can see our latest forecast growth does have economic activity dropping by nearly 8% over the next year. Now, in some respects, that doesn't sound like much given how catastrophic we're talking, but it does make the global financial crisis look like a little bit of a ride in the park compared to what we're currently expecting. Now, in terms of what we're hearing from a lot of people out there, and again, noting that Infometrics has a slightly different view of how the economy is going to evolve, we very much see this as being a U-shaped recovery, whereas a lot of other economists out in the market there are talking about this being a V-shaped recovery, quite a short up, quite a short down, short down rather, short up. We're very much expecting it looks more like this graph here, which shows the levels of economic activity, and you can see that U shape is quite prominent through there. We're expecting that economic activity will decline for the next 12 to 18 months or so, and then remain at that lower level for another 6 to 9 months before slowly starting to pick up again. And it's going to take, by our estimates, around about 3.5 years or so for the economy to get back to the same position that it was pre-COVID-19. And of course, there's still more activity that we have foregone through this crisis. Now, it's important to note that while we do see this as being worse than the global financial crisis back in 08-09, it isn't as bad yet as the Great Depression. Under a Great Depression style scenario, you can see in this graph what we would call more of an L-shaped collapse. Economic activity just doesn't come back to the same degree. It holds at that much lower level for much longer there, and of course some severe risks with how our economy develops through all of that. Now, I wanted to show you a few more sort of quick indicators of how we expect the economy is progressing. The first one was some numbers we got out in the last couple of days, and this shows the monthly car registrations. Again, just national figures, but you can see, unsurprisingly, how quick these numbers dropped. These are monthly car registrations for March, and we know that March, yes, we went into lockdown on the 27th. That still provided, 26 days though of not normal activity by any stretch of the imagination, but shows just how quickly that drop came through in terms of one part of how households make decisions, and that's around buying a car. And I guess with all of this, the point I want to make with the national outlook is it is going to take a lot longer for the economy to recover, and it's not like a normal crisis, and I do want to make that point quite clearly in this webinar. Traditionally, when we think of an economic crisis, and we've seen that in the likes of the GFC and even the Christchurch earthquakes and Kaikoura, is that we have a crisis and then we go very quickly into a short-term recovery, medium-term recovery, and then long-term recovery. Now, this isn't quite as clear-cut. We're currently at a level 4 lockdown. We are all currently stuck inside or operating only essential operations. I'm Zooming to you today from my ironing board desk and my flat in Wellington, so everything is very much not normal. But even once we get past those level 4 lockdowns, we don't just go back to normal. We don't go out and run about like we previously did. We may well be at some sort of level 3 or level 2 lockdown for much longer. At level 3, there are still severe curtailments on how a lot of our spending operations continue, for example, cafes and bars and how they can operate. And at level 2, even then, non-essential travel is prohibited. So there's still issues around domestic tourism being able to come back. Essentially, we do have to get through and shuffle out the COVID-19 virus as quickly as we can to have the best shot at performing, having the economy perform again. And so I do want to make that point that this is a much longer sort of burn in terms of how we see the economy develop. But look, I wanted to turn to some other national level figures that we've got coming through here, and I'll turn to them in a minute. I'll just make sure I have all the different pieces up. The first one is around how we see the retail sector going, and I know that's actually quite an important point for the likes of Kapiti. There is a lot of consumer activity going on there, and I'll just make sure I can share my screen here. I'll come to that one in a second. But we've got some numbers through from Market View, which provides us a bit of a national level oversight into how some of the spending trends are moving. And of course, there are specific numbers for Kapiti, but I wanted to go through the national stuff just to give you a picture of how we're currently moving. So there's a bit of some headline figures in this table, and I'll just focus on the totals for a minute. So over the period 9 February to 2 April, let's call that nearly 2 months, we've seen total retail spending activity down nearly 3%. And it's worth keeping in mind that certainly most of February was as close as possible, a bit more business as usual. In the week leading up to lockdown, so lockdown started at 11:59 on Wednesday, the 26th of March. Now let's call that Thursday, the 27th, is when it really started. For that week leading up to lockdown, we saw actually a nearly 10% rise in retail activity compared to the same period a year before, and that's because people were going out and panic buying, and you can see that there with a 60% increase over normal baseline levels for food, liquor, and pharmacies. Everyone was going to stock up, but also an increase of just slightly more in percentage terms for home and recreational retailing. That was everyone essentially going out there to find a desk and set up their home office and those sort of elements. Now, the first day, and apologies, I've mislabeled that slightly. The first day of lockdown there, we have, a essential drop off a cliff of all activity. And so spending over the day was, 3/4 down on its normal levels. Oops, excuse me. But what's interesting is how that's evolved post, or as we've sort of settled into lockdown. So for the week after lockdown started, the 27th of March through the 2nd of April, again, we see that retail spending low, but it has rebounded a touch, and of course it's rebounded in those areas that can continue operating. So most of the areas we've got here, hospitality, even some of the home retailing, that has dropped significantly. We've still got quite a large drop in fuel and automotive retailing, but actually a slight increase in that food retailing. So even though we're stuck at home and supermarkets is the only area we can buy from, there's still only a little bit of growth in there, and that is sort of keeping the lights on at the moment. The economy is very much in life support, and that spending activity is not to the same degree that we've previously seen it. One of the other areas, though, I wanted to show you is some of our trade data, and if we look if we look first at China and just look at some of the areas where we're seeing with Chinese trade, because we know it's an important part of our trade picture, and it gives us an idea of how New Zealand as an economy will look to perform. You can see that dairy there is actually was soft, certainly over a lot of February, and then coming back quite quickly as we started to move some of our New Zealand goods into and through Chinese ports. But the likes of forestry and meat remaining quite soft, and so some still sustained softness throughout the trade market there with China. But actually, if we look at that for all countries, it presents actually quite an interesting story that on a total basis, if we look at all goods trades that New Zealand has exported over the essentially 2 months from 1 Feb to 25 March, we're looking at a nearly 2% rise in our total exports. And in fact, that's seen dairy come up in a pretty good shape, similar to what I showed you before for China. But it's interesting as well that our meat products have come back through as well with a little bit more strength and have recovered sort of throughout the second half of March. And the reason I wanted to outline that is because one of the areas I want to focus on today is a lot of the rest of this presentation and already so far has been pretty doom and gloom. There's not a huge amount of positive news in through all of this, but I think it is important to remember that New Zealand's food and beverage sector remains a really critical part of our economic recovery as we come through all of this and we look to where the economy heads in the future. So there is a lot of activity still in that food sector. We know that overseas people continue to demand our food. There's still mouths to feed. And that provides us with a lot more strength in our trade position than a lot of other economies. So there is, I guess, a glimmer of hope in that particular area there. One of the other areas I wanted to focus on, though, and turning to Kapiti a little bit more at the moment, is just where our expectations of construction go, because we know that in recent years construction has become the largest core sector in Kapiti Coast, and there is a lot of activity there, and questions are starting to come from across the country in terms of where does construction go next. Now that's probably even more acute for some in the Kapiti business community, thinking about what happens when Transmission Gully and some of those other projects come to the end of their time, and we know that is fast approaching, and understanding sort of what are the next steps that we see coming through. So just briefly on that, and I won't go through sort of all the detail because there's a few other things I want to unpack, but it is worth noting that for Kapiti, you know, there is an expectation that infrastructure will provide a lot of support for them, and I think there is some really strong fundamentals with Kapiti Coast's construction sector. They have a very clear and very strong supply chain there, from the actual, you know, workers themselves back through to the different supplies they require, the sort of input materials. And I suspect as the government gears up to support both local government and private businesses to invest more in some of our network infrastructure, there will be, I guess, still work there for some of those firms. And it's about trying to make sure we bridge that divide where they currently can't operate through the lockdown, and thinking where do we go next with that. And so with construction, we are expecting that residential activity, house building if you will decline significantly across the country. It's basically because we're expecting house prices to begin falling because people can't make their payments across the country. Even with a mortgage holiday, that really only sort of kicks the can down the road 6 months or so. With those lower house prices, we're expecting that developers and that won't be as keen to put forward more houses onto the market. They won't get as much money as they had previously expected, and so we are thinking that that residential sector will see some softness in the near term, particularly as well as population growth slows, and we know that's one of the reasons that often construction has shifted ahead. On non-residential, we're expecting that anything that was privately backed, you know, new accommodation elements, additional retail stores, or new bars, shops, or restaurants, all of those sort of areas are going to decline quite quickly. No one's going to be building a heck of a lot in the private sector in the sort of coming year or so, and in fact it will be up to the government to support a lot of that non-residential activity. So additional sort of school building as well as hospital building is some of the areas we're looking at throughout the country. Now, of course, that leaves infrastructure as sort of the core area. We had actually been a little bit worried about the government's ability to deliver infrastructure prior to COVID-19. We knew there were capacity constraints. There were a lot of workers out there trying to do a huge amount of work that was on the books. With lower residential and non-residential activity, there is very much scope for those workers to be redeployed into the infrastructure area to boost the capacity of that sector. And so again, for someone like Kapiti, who now has a very, very ingrained supply chain from you know, the actual people building stuff through to their suppliers and their input materials, there is a lot of value, I think, for Kapiti businesses there to support that infrastructure we know will be coming down the pipeline. Now, a few other things I wanted to highlight with Kapiti, and I'll show you a few graphs if I can get them back up together. The first one is just looking at where the current unemployment rate is, because we do know that we are going to have a severe loss of jobs across the country, and again, not wanting to mince words. Now, Kapiti Coast is broad and has done for a while, broadly tracks the national average for the unemployment rate, but has dipped slightly lower than the national average over the last couple of quarters, and very much a good news story for the area. It's starting from a lower base, so there is a little bit more resistance to where we go to from there. But I do also want to point out that there are a core number of groups throughout the area, and this is indeed across New Zealand that I'm talking at this point, that we will see more disproportionately hit, and that's particularly young people and Māori. So during the global financial crisis, which does give us a bit of a read on how an economic crisis hits different groups, for the likes of Māori, we have seen a nearly 3 times the normal reduction in employment for Māori workers, which is quite a huge hit. And for young people, we know they are already more likely to be unemployed, and that is only likely to be exacerbated here. Those who are seen as more expendable, don't have the same level of skills, they are going to transition out of the workforce quite quickly, and there is a massive need to retrain them, to redeploy them as we get into the economic recovery a bit more. Wanting to touch on as well another trend that I think is quite useful in the Kapiti context, and that's looking at self-employment. And you can see this this graph here looks at Kapiti Coast's self-employment rate compared to the New Zealand average, and the Kapiti Coast average is far higher, and in fact you can see a little bit of a jump sort of around 2011 2012 after the GFC. And so I think what this does demonstrate is that Kapiti has quite a resilient little economy that can innovate quite quickly to I guess address some of these major economic conditions and start to pivot towards different opportunities. Now I say that because self-employment is you know, a key area. We're talking nearly 1 in every 3 jobs in the Kapiti Coast is self-employed, and so there's a lot of potential coming through there for people in the post-COVID recovery phase to start to think about sort of building a new business or to redeploy themselves into a new sort of industry or a new area. So there is definitely some strength there. Now, that self-employment rate is one of the highest in the country, and it is important to be aware that that's quite a different dynamic than the national average. You know, having 1 in every 3 people roughly who are working in Kapiti being self-employed presents some slightly different challenges in that we often, that obviously means we've got a lot more sort of sole operators, and they will need a lot more support as we go through this because they don't have the same level of access to business support that other larger businesses might not have the same connections either. An interesting question came through from someone who I suspect is on this webinar. I did want to touch on it because, again, we've sort of noted some of the issues at present, and we note for an area like Kapiti Coast, that retail remains a key area for the industrial makeup, but we also know that retail spending is unlikely to be an area that continues to the same degree post-COVID. Very much what I would expect to see for the retail sector is that consumers are going to clam up a little bit. They're going to sit on their wallets much more, and that discretionary spend is going to evaporate away. People are only going to go out and sort of spend on the core essentials, you know, making sure they've got shelter, a bit of food, but entertainment budgets and similar are going to be severely curtailed. And so it's going to be a different mix of how businesses respond to that very different, I guess, incentive from households. There's going to need to be a focus on really trying to extract maximum value from people and making it a worthwhile and a very local experience, I suspect, when it comes to that retail option. I've already noted the likes of the construction sector being a sort of a key area, and I think one which has much more resilience for Kapiti Coast, but is also important to maintain as we continue through this lockdown and sort of continue at levels of disruption throughout the next year or so. We've heard from Infrastructure New Zealand that some of the reporting they've done of their larger members indicates that around 30% of the infrastructure workforce could be lost in the next 3 months as firms decide to make some severe cuts to keep their businesses viable. And I think that's going to be a real challenge if that 30% number plays out, to ensure the infrastructure sector has the capacity to continue delivering additional infrastructure throughout the area. And like I said, Kapiti is well positioned for that, but it is important that those areas maintain some significant strength and support there. One of the other areas, of course, and in fact one of the largest sectors for Kapiti Coast is looking at the healthcare and social assistance area. We know that COVID-19 presents some severe challenges for the health sector, but also for those in the aged care area. And we know that Kapiti has one of the oldest populations, or largest proportions at least, of over 65-year-olds in the country. So again, presents a different issue, particularly when we know that some of those in the community of that age are are not going to be able to have the same sort of level of spending they've previously had. They will continue to get NZ Super, but a lot of the other support that they might have, financial support they might have built up themselves, particularly in KiwiSaver, may well not be in the strongest position with how the markets have disrupted themselves at present. I think the NZX down something like 13% over the last month or so. So definitely some concerns there over how older people are able to continue through all of this, and there is a lot more vulnerability there, I think, for someone somewhere rather like the Kapiti Coast. But one area that I think this does give a bit more of an opportunity towards, because it is important in a crisis like this that we think, where do we go from here, and sort of making sure we are still focusing on the future. And I think there is a big change coming through to how the economy will operate. There is a structural shift that we're seeing at present. We're going to have a huge amount of people who are laid off, and we're going to have to decide how to redeploy them. But it also means we can reconsider how we configure the economy. And I think given there's already been a focus on increased resilience across New Zealand, but also understanding our low emissions framework that the government is putting forward, I think there's also an opportunity here over the next 5 years or so to have a bit more investment in some of our green energy across the country. And Wellington as a region is quite well positioned to capitalise on some of that. There's going to be additional government spending coming through from a lot of different sectors to try and stimulate activity. And I think, again, trying to integrate some of those green energy projects alongside other infrastructure activity is going to provide a really strong amount of support for the local economy going forward. Now, one of the last areas I wanted to touch on before I sort of turn a little bit more to questions is going through, and I know that we've got some people on the call from sort of the more arts and creative sector, and just wanted to highlight that area as an area of much tougher times ahead. Like I said earlier, we are expecting that households will quite rapidly change their behaviour. There will be less consumption, less demand for a lot of what we generally see as economists, at least, as being that discretionary spending. All of that arts and culture and creative sort of sector, I suspect, will find it much more tough to operate as we go forward. People will be much more cautious about their spending for the next sort of year and a half, possibly longer. And I suspect as well that's why the government's ability to try and keep as many people in employment as possible will prove to be a critical point as we go through all of this. And there is, of course, that support from the government's wage subsidy package, as well as increased business loan support to keep as many people in jobs as possible. The last one, and I'm just sort of going through my notes to make sure I've covered off everything I thought I'd discuss, I guess is just understanding where do we actually go from here? What are some of the options I think we need to consider? The first one is trying to make sure that we have the ability to retrain, particularly some of our young people. They are going to be coming out of school or out of university or similar, and they're just not going to have the same job opportunities that we had pre-COVID, and they're not going to reappear for a few years yet. So there are some real struggles there for our young people going forward, getting them into work and locking them into that sort of pathway. And so I do suspect, given we know that there is still a high number of young people who are what we call NEETs, not in employment, education or training, there will need to be a strong focus on getting those people into some sort of activity. Now, noting it's going to be hard to get them straight into employment, I think there's a lot of scope here for trying to reskill a lot of people, change that skills mix so we have people who are able to sort of move up the job chain quicker, who can sort of have that idea of retraining, going back into Polytech or into a trades academy or similar, and getting those new skills for what we know the economy will emerge into later on. And we're doing a little bit of work here at Infometrics to understand what that sort of next step looks like, what skills are actually going to be in demand, what jobs are likely to be there in the next 2 to 3 years' time. So I'll update you on that one when we have some firmer numbers there. But look, that brings me mostly to the end of sort of my first part there. And so I'd really love to entertain some of your questions there if you'd like to type them into the question and answer box, and I'll start to go through them. I haven't got any at the moment, so feel free to lob some in. Otherwise, this may well be a slightly shorter webinar. Oh, fantastic. A couple straight away. That's always good. Okay, first one here coming from Paul around if a vaccine is reasonably quickly available, what effect will that have on some of our projections? Look, I think that will change things quite materially there, Paul. At the moment, we're feeling like a vaccine very much seems like it's a year or so away at a minimum. And certainly in terms of how the economy responds, again, both nationally but also for Kapiti, is that we're expecting the borders remain closed broadly for quite a while. Now, what that means is that we're not going to have any levels of international tourism coming in, nor international education, two rather large earners for the country. So we'll put those aside for a minute. We also know that as that continues, we're going to have lower net migration over the period, and so that will slow that population growth further. That slows the ability for households to continue operating, and it does restrict our ability to go forward there. Sorry, just check the chat quickly. And so I think there are some real risks over how quick a vaccine may come into play, and also how quickly it might be deployed in different countries. One of the risks we're very much anticipating at the moment around our projections is that if this continues unabated in other countries, it may well be that New Zealand recovers domestically at least as quickly as possible, but that the international activity remains softer and in recession for much longer, which will affect us because we are a small trading nation down here at the bottom of the South Pacific. So a little bit more risk coming through there. Certainly some upside if a vaccine manages to come through quickly, but I think to be realistic, that seems to be a while away, which is why our sort of 1.5 years or so of low activity, followed by sort of a 3.5 to 4 year time frame to really get through some of these challenges, remains our sort of central scenario there. Having a look at one of these other questions around sort of the property sector in the long and short term, will there still be demand for houses, or will it become a bit more of a buyer's market? Look, it's a really hard one, and we know that construction levels across the country, and Kapiti is no exception, have boosted ahead over the last 5 years or so. And in fact, nationally, we're now building we've consented rather 37,000 homes a year, which is at 1974 levels. So a lot of houses are currently in the pipeline. Now, our sort of expectation is that there are some areas across the country that are more vulnerable to house price declines. And I'll look at the prices first and then touch on the other part of the question. The focus at the moment, I think, remains very much on employment, because if people are still in their jobs, then they will, generally speaking, be able to pay their mortgage. However, if we do have a much larger number of people become unemployed or have their hours cut, there's a much greater chance that people will be forced to downsize their living arrangements by selling houses, and that will drive the price of housing lower. Now, I suspect that Kapiti is slightly better positioned in a sense than other parts of or other areas of the economy. It doesn't have the same reliance on tourism as some other parts do. Rotorua and certainly Queenstown Lakes are two areas that I think are very vulnerable to further house price declines, particularly Queenstown Lakes, because they've sort of built quite a lot of houses recently, but a lot of their house price growth in our minds has been driven by that economic growth. Without that economic growth, with sort of over nearly a quarter of their workforce directly employed in tourism, there's a lot more scope for house price falls there. So looking at Kapiti, I think there is still a bit of downside risk to that. I suspect as well what we're going to see is that there will be both a reduction in both demand and supply. People won't be quite as keen to put their house on the market because house prices are likely to go lower, and so a lot of the housing on the market will remain those people who have to sell more than want to sell. But on the demand side, we're also seeing that first home buyers have retreated quite quickly from the market. They're not as keen to try and get in when they know that cheaper houses are coming in the future if things bear out, but also because their ability to access their deposit has fallen quite a bit. Their KiwiSaver will have taken a hit, and so that ability to get on the property ladder makes it slightly more difficult. So I suspect there's probably a bit of a moderation in affordability. Becomes a little bit easier to get into a home, but of course that's true only for those who continue to have a job, and so still some issues coming through there. A question around how we see bank lending evolve, particularly to the residential sector. Look, I think there's some banks are going to be under a lot of pressure, and they're being sort of very quickly made into a little bit of a political football. At the moment, they are quickly, doing just as much work as central government seems to be to support businesses, and that's not a bad thing. And they have a critical role in functioning society here in New Zealand, given our focus on housing, particularly as an asset class. So I suspect there will be a lot of focus on the banks. We know that they've given out a mortgage holiday. We know that they're also lending out to businesses with a government guarantee, broadly speaking, behind them. And I think it will make businesses probably in a few months' time have a much more cautious approach to their general lending expectations. We know over the last couple of years that although interest rates have remained low, credit availability has been a little bit more difficult to come by. And we've heard stories of people's bank accounts being checked much more thoroughly when they go for a mortgage to ensure that they don't have too much frivolous spending in there. I suspect these sort of issues will continue as banks make sure that they are still lending to the market, but are also trying to keep an eye on their own exposure there. So a little bit more limited for some of the residential activity over the next period, I suspect. Question around the sort of the role of employment, employment schemes and sort of climate adaptation. I sort of noted some of that, some of the environmental policy stuff that might come through. I think the important thing when we are discussing where we go from here and when we look to the recovery here in New Zealand, and particularly up on the coast, one of the areas we want to focus on is spending money not only so that we get people in employment, but we keep people there and we add value throughout sort of a longer period. We don't just want to sort of, go out and make everyone dig ditches and get a second pair of people to fill them in and get the third bunch of people to dig the ditch again. There's got to be something productive that comes out of all of this work. And that's why investment in infrastructure, particularly green energy, I think is, as well as other sort of changes, will be quite critical there to try and understand as well how we transition the economy and how we also use certain parts of New Zealand, like Kapiti, as a bit of a springboard for the rest of New Zealand. How can Kapiti become one of the sort of leaders in these sort of recovery projects and shifting quite quickly back from crisis mode to recovery mode and lead the way for other regions and provide that good information. So I think there's a lot of strength there for employment because the focus is very much on not only getting people into work so that they can pay their bills, but also making something productive for the local area over a longer period of time. One of the other things, just because there's a couple of questions in here about industries, one of the numbers I did want to give you, and again, I'll share my screen briefly and make sure I've got it up here somewhere. That one, there we go. I just wanted to share some numbers that we've put together here at Infometrics around how the local economy is likely to be moving through, and apologies, this was hidden behind one of my tabs before. But by our estimates for the Kapiti Coast, we expect around about 26% of the local economy is still operating from home, doing its work probably from an ironing board like I am here. That 26% is slightly lower than the national average of 29%, and that's true for the workforce who are part of essential services as well as working from home. So by our estimates, the New Zealand average is around about 53% of the workforce can continue operating. For Kapiti, just a touch lower at 48%. Now, that's both, I guess, a good and a bad story depending on your viewpoint. On one hand, it's still half of the economy who's operating during what is essentially, the first time in New Zealand's history we've hit the emergency brake on the economy. At the same time, it's around about half of the workforce who is also not able to work, even if they well could, and construction's a key area there, where there's a lot of stuff for them to do, but they're not able to go and be out and about doing it. So some issues coming through there, but hopefully that gives you a little bit of an idea of just how many people we do expect are still operating out there in the economy. Question here around how the printing sector looks for into the future, and we're obviously seeing some changes in that sector. Look, I think generally speaking, printing would come into one of those areas where I see that to, from a consumer point of view, as having slightly more of a discretionary spend element. People are possibly not going to be quite as focused, but I think as well there is going to be a renewed focus on a bit of a more buy local sort of emphasis as we continue down, and we will see retail and some of our other providers adapt, I think, quite quickly to understanding how consumers now want to consume. Like I said, that more local element will be critical, and I think it's about a lot of the time promoting a lot of those opportunities for how businesses can connect. Oftentimes, consumers are turning to online retailers because that's sort of where they can search, and I suspect a little bit of coordination between business entities and the likes of the Kapiti Coast to remind people of what some of their local opportunities are could well go a long way up to providing some of the support for those sectors there. A question around our expectations for how many businesses may or may not open after the restrictions are lifted. Look, my broad feeling is, and I haven't got any specific numbers, but hopefully those work from home figures give a little bit more of a flavour. It does imply that around about half the workforce continues operating at the moment, and I think there are severe risks for anyone involved in the hospitality, the retail, and those sort of sectors, and anything more broadly tourism related, just because there will not be the flow of people coming through for a while yet. And that's true both of international tourists who I've already noted can't and won't be coming in for a while, but even under a level 2 lockdown, a level 2 COVID alert level, we know that non-essential travel is discouraged. So there remains sort of those risks around how many people may be out and about. So there are some sectors I think are going to struggle and may well be considering how they best repivot their business in the light of a new normal, because we, like I said earlier, we won't come out of this into the normal sort of area. Question around in terms of how long the banks will be able to continue to support homeowners who are struggling to pay mortgages. Look, it's a great question, and it's a query that I've had a few times around, what is the bank's capacity to continue for a while with this? Look, we know that the banks are in a strong position, and we know as well that the Reserve Bank and the government are providing additional stimulus to the wider economy. And so just to note sort of how some of those things are working, we've seen the Reserve Bank announce not only another large cut to the official cash rate a few weeks back, which has taken down short-term borrowing costs, but we've also seen them anticipate injecting up to $30 billion worth of quantitative easing into the system. Now, it all sounds pretty complicated. The broad thrust of it is that by doing that, the Reserve Bank is keeping long-term rates lower. Now, those long-term rates are what retail banks have to use to make sure that they still have their funding. So they are trying to keep retail banks funding rates lower. That means that you guys as businesses and as households maintain those lower rates throughout. So that provides a little bit more stimulus in the system. We also know that the Reserve Bank has said that banks won't have to implement the additional capital holding requirements that were scheduled for this year. That frees up $47 billion worth of additional funding over the next year that banks can lend out. So there's still a lot of support there. I think the focus will be in 6 months' time, the bank's evaluating with homeowners and with businesses what the outlook may look like for their specific scenario. For some businesses, and again, without being overly pessimistic, but wanting to be relatively blunt, because this is a large shift in the economy, there are some businesses that even after 6 months are not going to look viable into the future, and there is going to have to be some hard conversations about what that means for their lending output. And the same exists for households. There may well be some who cannot continue to afford their current level of mortgage repayments, and they may well decide that they need to sell. And so that's where we're going to see some of the house price declines coming from there. Question around sort of our expectations for imported goods and timeframes. Look, from what our understanding is, broadly speaking as well, our imports continue to sort of come into the country. There's no major issues coming through there. We are, of course, expecting they will drop both, particularly because we're not going to see businesses who are going to invest to the same degree, and without that investment, we are going to see our imports drop. So there is very much, I guess, a demand side shock to that. Broadly speaking, what we've heard is that there's not a huge amount of supply chain shock yet, and where there is, businesses are pivoting quite quickly across New Zealand to make do as quickly as possible. So my expectation for imports is that they are broadly settling in a better position. Of course, the risk remains that that changes if there's a sustained pandemic throughout the world, and that may well push some of those supply chains to breaking points over a longer period. Question around how long the government guaranteed business loan sort of scheme will be available. Look, I think government is, quite rightly, to be clear, making up policy a little bit on the fly. This is a very rapidly evolving situation, so I don't know if they even have considered that answer yet. But certainly until June seems to be an area of focus for many. From a central government point of view, a lot of the expectations and consultations we've seen so far extend deadlines up until the end of June. And I also know, talking to a number of councils around the country, and indeed in Wellington region, that the focus is on sort of possible deferments for the next 3 to 6 months. Now, the reason I think for that, and not saying that after that everything goes back to its normal hard-nosed self, but I think instead what it does is it buys us a little time to take a breath and see where the economy is sitting at that period in the future. By June, I do suspect we'll have a better view of how the economy is evolving, and we'll be able to start thinking about when that next recovery phase starts to come into play. So not sure how long it will be available. Certainly my view would be that now is the right time to start talking to your banker and or your financial advisor, just to make sure you're aware of your options and sort of where to from here. Another question around some of the government support here, with government support schemes and the wage subsidy, and how long that might come through. Look, I'm not 100% sure there, and I suspect there is going to be some hard questions being asked by senior officials at Treasury, but also in the Finance Minister's office, over how we're best to sort of go into the future with some of these wage subsidy schemes. We're already expecting sort of 10 billion or so to be spent out, and I think already we've spent nearly 6 billion on the wage subsidy so far. So there is a lot of money still being poured into the system there. Now, in terms of where we go to from here, I guess there is a risk that government decides that it does want to pivot, or that it is given enough support. And I also think actually what will be more important than when the government decides to pull the pin or not in terms of the wage subsidy timeframe will be businesses evaluating what their own outlook looks like. For a lot of businesses I've talked to, even though they may be paying the full wage subsidy through to their workers, they may well be sort of considering, look, if my business doesn't look viable in another 6 months' time, is it worth sort of delaying the inevitable? So I do suspect there'll be a lot of thinking going on in businesses for how and for how long, rather, they may want to continue operating, just given where that some of their sectors might be. Because like I said, we are going to see a large number of business closures. We are going to see a large number of people become unemployed. It is just that large of a shock in the economy there. A question around, how businesses are going to operate post-COVID, and I think it's a really good question coming through there, and speaks, I guess, to what I was trying to demonstrate before, in that we are going to emerge post-COVID into a new normal. We're not going to bounce back to what we previously had. We are going to have a structural adjustment, a bit of a shift change in our thinking. And I suspect it will I guess, involve a lot more digital technology through all of this. Both for like I said, for some retail stores there, and possibly also for some of our more hospitality-based entities, there will be some thinking around how do I make sure there is still some sort of digital platform, because we know that is how people are shifting. And certainly after a pandemic, I think that's generally how people will want to interact, a little bit more standoffish in person, and therefore using digital technology. At the same time, I think for a lot of other services, and I'd note that one of the largest sectors in Kapiti Coast as well is the professional services sector. So think, your accountants, your lawyers, and what have you. All of those sort of people are going to be reconsidering how they do business as we go forward. One of the areas I think that is ripe for the picking, and in fact, today's webinar is a good example, is I'm able to do this from my lounge in Wellington. Now, it might not be super high tech, but it does allow people to sort of work from essentially anywhere that they want to be. And I think we are going to see a bit of a breakdown in the traditional working from the office sort of environment that a lot of professional businesses currently operate with. There will be a lot more working from home, a lot more of that remote working, and people being able to operate at different areas. And I think actually that provides a bit of an opportunity for the Kapiti Coast. Some of the numbers we got out of the census last in 2018, and don't get me wrong, the census wasn't the most fantastic piece of analysis we've ever had, but what it did show, which was really interesting, was that there was actually an increase in people who worked in Wellington City, who lived in Wellington City but worked out in Kapiti. And I think one of that trend, alongside how people are starting to respond to the COVID-19 pandemic, I do think there is going to be a little bit of a shift towards more regional centres like Kapiti, because people will be able to live and work in the area, but also maintain connections to some of our larger urban centres like Wellington. So using a bit more digital connectivity, I think there's an opportunity there for Kapiti to really reinvigorate itself as an area of fantastic lifestyle that people can work from, but at the same time having that access to wider and possibly more urban office environments through a bit more of a digital connection. Question around business closures and lockdown in terms of reflecting the national patterns or having a bit more of a regional pattern. Look, it's a great question. I suspect that in some regards, Kapiti is a little bit more insulated than other parts of the economy. Like I said, I think tourism is going to be an area that's going to be hit particularly hard, and that sector is not as large in Kapiti as other areas or as the national average. So a little bit of a balance there. One of the areas, though, that we do see there being weakness in is the retail sector, and that is a large sector in Kapiti. So if you will bring that one back down a bit into balance. The construction sector, I think, is a bit more of a wild card at the moment. Certainly over the last 2 weeks, my view is moderated from the construction sector being quite a strong and resilient part of the economy to hearing a number of stories from construction leaders that it was more a question of how many rather than if or when they would lay off staff or have to close. So I think there's a bit of tension there with the construction sector, and actually it's going to be important for local government particularly, and hopefully there are some on this call who make sure that planning, particularly for capital works, goes on. Important to note, every time you hear about a 0% rates increase as well, which we're hearing increasingly across the country, all that means is that you may well need to pay a much higher rates increase in 3 years' time, which in fact I think would stymie and really hurt the area's local recovery, because people are going to be just getting back into the swing of things and then being hit with a much larger cost. So I suspect it may well be better to have deferral on rates for the next sort of 6 months or so and maintain that sort of stronger ability to come through this out the other side. A couple other questions coming through here. I'm just trying to sort of get through all of them. I note we're getting a bit closer to time. Question around major events contributing to the economic recovery, and I think there's an interesting question there around how our events policy will evolve post-COVID. I think certainly in the next 6 to 9 months will be a little bit more resistance to how the economy will and how households will respond to different types of events. A lot of stuff that where we're all crushed together in a bit more of a mosh pit style event may well not go down very well in the post-pandemic world, but I think trying to engage the community and show that the area is still open for business and supporting getting people back into shops and out and about will be a key area of focus. So I think there are some ways to use events. It's just going to be making sure they are managed in an appropriate way there. Question around sort of how the working from home is going to work in that, and a question around sort of possible 4-day weeks and those sort of elements. I think what we've seen quite quickly through this pandemic is that whenever someone was told that it was too hard to work from home or it was too difficult, that actually it's probably a lot easier than they suspected. Take Infometrics, for example. We already had half the team who worked from home most of the week. We've very quickly been able to pivot onto using Teams and Zoom and all these other sort of digital connections to ensure we continue to deliver insights to clients and to people like yourselves. So I think there is going to be a renewed focus on how that sort of future workforce emerges, and we're going to have to take that into account when we consider this sort of the retraining, particularly of some of our young people and Māori, to make sure that when we are getting them ready for the workforce again, that we're getting them ready for the workforce we're going into, not the workforce we've just left behind there. Question around prospects for online retailing and delivering that. I think level 3, and there's a question around sort of will level 3 give us a bit more room to breathe, and I think that's very much true, and there is going to be and already has been a bit of a shift in how consumers are wanting to receive their goods. We already know there's been a massive increase over the last couple of years in some of the consumer models, and one of the most interesting, I think, is the subscription model that we see across the world. People are buying anything from music to razor blades on a subscription and sort of a monthly basis or so. And so that does provide, I guess, a new retail opportunity that may well not have been thought about before. We've also seen it with hiring cars from Turner's Auctions, who are providing that, as well as some dentists who are offering a subscription model across the year that entitles people to a certain amount of service for a monthly cost. And so I think that subscription idea is going to take off even more in New Zealand now, as we think more towards that online retailing, and as people continue to move more towards getting stuff delivered to them rather than going out and getting it themselves. Question around, how does the economy change given that we're not going to go from level 4 back to normal, but we may well sort of pivot between level 4, level 3, level 2, back to level 4, up and down. And I think, I don't have any sort of firm views in terms of how businesses best respond, because it is going to be very industry dependent. We obviously know that tourism essentially can't operate even under a level 2, but there is some limited scope for a bit more retail and hospitality activity through some of the other alert levels. What I think is probably important is to understand as a business, and also understand as a business community, what some of those options are to continue providing services under different levels of lockdown. It's not useful, I don't think, to plan for a COVID and a recovery phase, because they're a little bit too lumpy in that sense. I think it's going to be much more useful for businesses to understand how they can continue operating during these different levels, and how they need to adjust their business operations to meet those restrictions at the different levels. That's going to be much more useful. And again, if people haven't already, I think it's worthwhile understanding what that business operation means, and who else you can reach out to for additional sort of assistance there. All right, just trying to go through and cover off a few that we haven't already done. Question in terms of the projections on how the economy looks like under a level 4 lockdown for, say, 4 weeks, 6 weeks, or 8 weeks. Look, we're one of the things that economists are great at is talking about trade-offs without any recognition of how people come through some of these issues. And so it might well be that we economists attach, a dollar figure to the value of a life and things like that. What we're doing as economists at the moment is letting health professionals take the front seat broadly, because actually for a lot of it, having a lockdown is probably still the best economic method of making sure the economy can recover as quickly as possible. If we have to go for longer, I think that is going to stretch businesses' cash flows to a much greater degree. There will be a lot more concern over how long businesses remain viable, and how their exit strategy may be. How long do they go before they might have to reconsider their operations in a vastly different way? I think it's the writing is both getting clearer and more muddy all the time. Certainly the expectation I would have had, say, a week ago was that the lockdown looked like it may well have been for a minimum of 6 weeks, really, just in terms of thinking about how important it is to try and stamp out COVID-19. But there's also a focus, I think, at the moment on those lower case numbers we continue to see coming through day by day, and seeing, or starting to see, the emerging signs that the curve is flattening. And I think that is a key element to understanding how New Zealand gets back to operation, and also for the government to think about how it could provide a bit more regionally focused COVID alert levels, so that we can get some areas who are in a much better position up and running a lot faster there. Just going through a few more, because I know we're almost at time, and just seeing there's quite a few. Sorry, I'm just wanting to make sure we've got some there. Probably the question I do want to pick up on, just because I've been thinking a little bit more about the recovery at the moment, is looking at the bottom of that U-shaped downward spiral, and understanding sort of where we operate there. Essentially what we've done with the economy is we have sort of put it on life support, and we are trying to maintain as much base momentum as possible. So it's not business as usual, it's just trying to keep people ticking over as much as possible until we can sort of restart that economic engine and zoom out. But that's why I also did note that we are expecting that economic activity will remain low for the next 18 months or so. And the reason for that is because what we generally expect through a downturn, and this will be no different, is that as we have some businesses close and employers laid off, those other businesses who used to get patronage from the original set of people who have been laid off, they now have less economic activity coming through their doors. They're being able to shift less product, and so there's a self-replicating downward spiral of activity, and trying to keep that as limited as possible is quite critical as we sort of hit that downwards U shape. And another and probably one of the last questions I'll go through here, and I'll just make sure that we're trying to get through some of them. And there's an interesting question here around sort of thinking about that recovery again, and the use of internships or apprenticeships supported by both industry and government as an option for retraining workers, particularly where some of the financial stability in the short term isn't quite as available. And I think there is real merit in that idea, and I suspect there will be an increased need for some of our current educational and training changes to come through much more rapidly. We know the government's already embarking on its changes and its creation of regional skills leadership groups, and I suspect having those sort of groups operating and as key areas of focus for the next sort of 9 to 18 months will remain critical, because those groups are going to bring together the people who are going to deliver some of the education alongside businesses and industry leaders who know what sort of jobs are going to come through the pipeline, along with some other key community decision makers, to make sure that pipeline is very well created for new jobs. You don't want to have, I guess, a bit of missing direction where educators are trying to retrain people in areas that employers don't need as many workers in. And so that sort of comprehensive and integrated approach to retraining will be critical to make sure that you can, as quickly as possible, get people from unemployment through into education and training and out into a job. And like you say, apprenticeships and internships provide a really lucrative option, particularly because it gets people to learn on the job. You know, there is a very tangible real world element to their learning that's not just purely in the theoretical when they're in the classroom. So a lot, I think, of additional value there. I'm just looking through some of the other ones. There is definitely, I've tried to cover sort of as many as I can, but I will finish on this one because I think it's a worthwhile, area to focus on, and it is a little bit more optimistic and future focused, and that's around sort of the effects on tertiary education and universities. Look, what we know is during times of downturns, everyone does move back towards education. There is a huge amount of demand for that ability to retrain. A lot of people who take a little bit more time off to go, look, it's difficult to find a job. I'm going to focus instead on reskilling myself, on making sure I'm in the best position to get into a job once I've moved through my education. So I suspect there will be a lot more of a focus on that. But I also wonder if there will be a focus not only on the traditional sort of university pathway, but increasingly a bit more of a focus on the trades throughout New Zealand. We know that we're going to need more of those people to provide the infrastructure stimulus we've got coming through. But there will also be, I think, a lot more focus on digital skills in some of our retraining as people do look to re-engage in a different way when it comes to business and operations. Look, hope I certainly haven't answered, I don't think, quite all of the questions. There's still a few to go, and I'll try to provide some written comments back to Kapiti Coast District Council. But look, I hope that was useful. I hope it's provided a little bit more information about how the local area is going. I think my broad comment is that Kapiti Coast looks like it is possibly in a slightly better position than other areas. It has a tad more resilience through it, but not wanting to mince words and noting this is a severe economic event, and it does begin to rival the Great Depression back in the 1930s. Look, thank you everyone for coming along. I hope it's been useful, and stay safe. And if you have any other questions, feel free to get in touch with myself or any of the other Infometrics team. Have a good afternoon. Cheers.